In the past few years, the UK has seen a rise in the tax burden, but at the same time, the UK has seen a reduction in the average rate of economic growth. Is low growth leading to a higher tax burden, or is the high tax burden itself contributing to lower growth? We'll try and untangle this relationship. But first, here's a graph which shows the relationship between tax rates and GDP per capita. You can see there's an inverse relationship, with higher tax levels generally associated with better living standards. France, Denmark and Scandinavia, countries with the highest tax, have also the highest living standards. Poorer countries generally have lower tax rates. Now there are exceptions. Saudi Arabia and Kuwait get so much money from oil they don't need to tax. Singapore is often cited as an example of low tax and high GDP. There was once a hope to turn a post-Brexit Britain into a kind of Singapore-on-Thames style economy, but this was dashed somewhat during Liz Truss's 44-day reign in power. Now, when asking subscribers for economic questions, the most popular one was, does higher tax lead to lower rates of economic growth? But first, let us put the UK into context. The tax share is relatively low compared to other European countries. And although the UK tax share is rising, it's worth bearing in mind it's also been rising in other countries too. But does this higher tax reduce economic growth? One way of thinking about this question is, can a government spend tax revenue more efficiently and more productively than if we had left that money in the private sector? If you increase tax rates, there will be a disincentive effect. Higher corporation tax, probably less business investment. Higher income tax, reduce the incentive to work and less private sector spending. Now, if a government uses this tax revenue to spend on, say, white elephants or buying PPE equipment that is later destroyed, then economic growth prospects are diminished. However, if a government used this tax revenue to, say, build housing, which enables lower housing costs and more geographical mobility, it could contribute to economic growth in a way the private sector can't. Now, in some areas, the private sector is more efficient at investing money. But if we left roads, justice and education entirely to the private sector, economic growth in the long term would suffer. So finding that balance is the key. Now, the famous, or perhaps I should say infamous, Laffer curve claimed that if you cut income tax rates, in theory the government can get more revenue and boost economic growth. Because if you had a tax rate of 100%, people wouldn't work and revenue would be zero. So if you cut tax rates, then you get more money because people start working. Now, when France had an 85% super tax rate in about 2013, it led to millionaires leaving the country to live in places like Belgium, and it was scrapped after a year because it had raised much less revenue than it expected. Certainly didn't help economic growth. Now, after becoming the biggest party in recent elections, the new French Popular Front want to impose a 90% marginal tax rate on incomes over €400,000. Now, even if you like the idea of soaking the rich, it's hard to see any other outcome than French millionaires moving to other countries, tax havens like Monaco or wherever else in Europe where you can avoid paying this 90% tax rate. At that level, it's a huge disincentive. Now, France, you could say, is a bit of an exception. Suppose the UK increased its income tax rate from 20 to 25%. Give the government a lot more money to spend on healthcare and building new prisons and housing and things like that. But the question is, would you want to work more or less? Because on the one hand, work is less attractive. Why do overtime when the government get to keep more of your money? But on the other hand, if you need to gain a target income to pay your mortgage and school fees or whatever, higher tax can actually, in a way, be an incentive to have to work longer hours to meet your target income. Now, it depends very much on the individual. In my case, if I get a higher hourly wage, I tend to prefer to work less. And if tax rates went up and hourly wage went down, I might actually work more. But it's very much an individual thing. Generally speaking, though, evidence suggests that an increase in tax rates has a very minimal effect on incentives to work at low tax rates. Until you start to get above, say, 60 to 70%, that's when disincentive effects tend to be greater, leading to constraints on economic growth. Now, there are studies which suggest that countries with higher tax rates generally have lower economic growth rates. This shows a negative relationship for OECD economies, though there are outliers such as Korea, whose strong growth is much more than having low tax. But if that's the case, why is it then that rich countries have higher tax burdens? Well, when a country is developing, it tends to have a lower tax burden because the government lacks the infrastructure and ability to raise tax on, say, subsistence farmers. In other words, because it is poor, tax rates and government spending is low. But very poor countries have a capacity to catch up with the rest of the world, and they can, although not always, grow quite quickly. Very rich countries tend to see rising tax burdens because as incomes rise, voters tend to want to have more spending on healthcare and government pensions. In other words, higher incomes give economies the luxury of higher taxes and a welfare state. But even the link between tax rates and economic growth is not always clear-cut. This study shows that for European Union countries with higher tax rates like Scandinavia had actually slightly higher economic growth rates than lower tax countries like Italy and Greece. But if you take Italy and Greece as an example, is there low economic growth due to tax rates or other problems like an ageing population, cronyism, lack of investment and political instability? In the post-war period, the US actually had much higher marginal rates of tax on high earners, and higher corporation tax too. In recent decades, corporation tax and income tax have come down. However, growth rates have also fallen in America. The link between the highest marginal tax rates and growth is hard to see. So this shows that high marginal tax rates are not necessarily a barrier to growth. But again, it would be a mistake to place too much emphasis on this because in the aftermath of the Second World War, there was a greater sense of social cohesion and willingness to pay tax. It was also much harder in those days to move around the world and avoid paying tax. If you tried to replicate the high marginal tax rates of the 1950s in today's climate, most multinational companies would tend to find ways to shift profit through tax havens like Luxembourg and Ireland. Ireland's GDP is heavily distorted by this low tax effect, but it also gives a misleading guide to actual living standards, which are not captured by GDP. Another factor is that it depends what taxes are raised. Studies by NIESR claim that increasing corporation tax would have the biggest negative effect on economic growth, more so than income tax or VAT. And this is because companies have the ability to invest elsewhere. For example, again, Ireland boosted its GDP by ultra-low corporation tax, which caused a lot of inward investment by American multinationals seeking lower tax rates. But it is worth stressing that this very low corporation tax is an example of what we call beggar thy neighbour. Ireland only benefit from a low tax rate because other countries are higher. If all countries had this same 3% corporation tax, there would be no relative benefit. And this is why global cooperation on minimum tax rates are a good idea. Now, we've talked a lot about tax rates and economic growth, but it is really important to bear in mind that there are other things much more important than economic growth. Free public healthcare, pensions and education requires higher taxes, but it can raise quality of life in a way that focus on growth may not. The US has lower tax rates, but workers and firms face quite high private healthcare costs. So it's a moot point whether lower tax is better if you have to pay more private insurance. Also, you can be privately rich, but publicly poor. You can be a millionaire with loads of money in the bank, but if the country's public goods like prisons, justice system, education and healthcare are all flawed, then this private wealth has diminishing returns. What use is economic growth and high GDP if you can't see a doctor? Now, the French economy is in crisis, and it's really hard to see that a 90% income tax rate is going to turn this around. This video looks at all the reasons for the French economic crisis.